Mustafa. Here we are.
So we didn't say hi, that's why. Sorry. So welcome. So I know that there are lots of sessions going on around the place, and we have also upstairs, country sessions, startup pitches, also roundtable discussions. And thank you very much. And I believe this is one of the sexy topics, right? In terms of the fintech discussion. So so whenever there's this new project, startups, scale-ups, even scale-ups for their follow-on investments, so they always need funding to sustain their businesses. So, but well, as this is something quite important, but in the meantime there are lots of intricacies in terms of matching the right investment or set of investors with the right investees. So in a way, so. But the thing is, aside from having these lots of complexities and intricacies, fintech itself is a bit of a peculiar subject, and it's not quite easy to understand all the time because it is trying to serve to a very regulated industry. I'm referring both to not both basically, but to the banking as well as to insurance, as well as to payments. In the meantime, capital markets. So it is not something quite easy to understand, and you need to look into all the details whenever it comes to funding and basically investing in an opportunity and in a prospect. So, so we will be touching upon all these things, even though we have some notes and descriptions in terms of the panel. But I have a very good roster of speakers on the stage. And perhaps I should leave each of you to introduce yourselves. So why don't you start, Yusuf, from the very end.
Thank you, Mustafa. My name is Yusuf Özdalga. I'm a partner with QED Investors. I'm the head of the UK office based in London. QED is a fintech fund focused on seed and Series A investments. We were founded in the US, but we now invest globally. We have a big portfolio in Latin America, which includes Nubank. In the US, we've done 6 out of the top 10 fintech unicorns, including companies like SoFi, Credit Karma, GreenSky, Prosper, and Avant. And in the UK, which is where I'm based, as I said, we have Zopa, ClearScore, Wavestream, Capitalize, and others in our portfolio.
Thank you. John, please.
Yeah, hi, I'm John Sharp. I'm the founder of Hatcher. We're an AI-based, data-driven VC based out of Singapore, Dubai, and Miami. We are currently the second most active early-stage investor in the world. We invest in everything. We invest in every geography. If there's technology involved, then we invest in it. We invest very small tickets. I'm investing 2 stages before my peers here in on the podium. In particular, we had a first fund, and our first fund was a very traditional fund. This fund is dedicated towards creating the world's largest portfolio. We're looking to create a portfolio of 1,300 companies. So approximately 7% of those companies will be fintech companies. So I'm going to leave the harder fintech questions to my colleagues up here.
James, go on.
And I suppose, contrary to John's business, we're actually a stage-agnostic fintech fund. So we're sector-specific. Fintech fund. I run the banking and payments portfolio out of London. We essentially have 3 vehicles: a private equity and leverage buyout vehicle, which is very much at the top end of the fintech scale. We have a venture capital vehicle where we write tickets between 1 and 5, and then we have at the bottom, which is an incubation vehicle, which is where we participate with the industry to bring like-minded financial institutions together to collaborate on particular areas of the value chain. And then essentially what that enables us to do is to participate in any part of the fintech lifecycle for a business, and ideally participate through the growth of a business.
Good morning, Eric Finkier. I'm one of the general partners of InsurTech Venture Partners, which is an InsurTech focused vehicle which at the same time only accepts money from insurance investors. So the approach is, one is of course to invest in attractive insurtechs, but also to help the insurance companies who are our investors to grapple with the innovation and the new aspects that they have to learn, and which are an additional benefit for in particular insurers, to invest in InsurTech. Besides that, I'm also a board member of the Institute and Faculty of Actuaries, where I chair research and innovation, and I'm also a board member of a number of insurance companies that have been acquired by private equity, where I'm very often either chief investment officer or chair of the investment committee.
Well, thank you very much. And well, if you just excuse me, I need to make an announcement because of an emergency outside. 34 GB 1414 plakalı aracın sahibi. Aracınızı çekebilirseniz, bilmiyorum burada mıdır kendisi ama 34 GB 1414. Anladığım kadarıyla bir sıkışıklık var dışarıda. Teşekkürler. Sorry about that. So, taking the definition of fintech in a broader way. So by fintech, I don't only mean payments. I don't only mean credit scoring. That includes insurtech, regtech, blockchain, AI, as long as it touches upon, all financial services. So why investing in fintech, Yusuf?
I think so.
Okay.
While they are fixing it, perhaps James...
Shall I?
Is that
Shall I
okay?
begin
Okay.
with?
Yeah, okay.
All
So
right.
Yeah, I mean, for me
sorry.
personally, fintech is interesting. I studied in the U.S., even though I grew up in Turkey, and I, did finance and MIS, and was trying to think, should I go into banking, something technology related, and in the end, I ended up joining Capital One back in '97. It was 3 years since they had done their IPO, and it was a very exciting, fast-growing place. And what I liked about it is it combined technology with finance. Later on, when I was at JP Morgan, we were involved in the acquisition of Bank One, which is how Jamie Dimon came to join JP Morgan as CEO. And there also I saw that he didn't think of finance as just finance, he thought of it as technology. So for us, finance and technology have always gone hand in hand. So whether it's core banking systems and other things at JP Morgan or it's data mining at Capital One, you can't really do finance without having a strong technology background. So there's been a lot of specific developments we can talk about, which has driven the recent boom and the name fintech. But even before the name existed, I think fintech always existed. Even money, paper money, is a form of technology. So that's why we invest in it. And the second answer is because we know it well. We've been doing it for, on average, 20 to 25 years across the partnerships, and we have more than 10 partners. So we have a pretty wide base of knowledge in the field.
Okay. All right. Perhaps, Eric, you can just,
Well, I mean, let me add a few extra angles here. Of course, on the one hand, you can invest in the equity, early stage, Series A, Series B, IPO, and so you can invest in the equity. But there's also another angle, which is that, in particular, banking is now very heavily regulated, struggles with capital, Basel III, and you just see banks to some extent being disintermediated and finance being done by different sources of capital around the world. Now, as an investor of insurance balance sheets, I also struggle because 20 years ago you would have had a lot of government debt, but today this is a very unattractive asset to hold. And the second thing, which I'm going to bring in here, is that we're very interested in financing through ways of fintech, startups or slightly more mature businesses, but financing the global economy in different ways. For instance, financing as an alternative to holding government bonds, doing trade finance, doing direct lending to SMEs, doing direct acquisition financing and so forth, leverage loans and so forth. And very often there is, for a startup that is a little bit involved, there is also a need for financing in debt format and not just in equity format. And of course, being a new company with not necessarily the greatest track record, you will be looking for specialist investors who understand your business, because it's different to support a brand new trade finance platform than to give your money to BNP Paribas, and BNP Paribas will do the trade financing, etc. So you start to see forms of fixed income financing to companies which are new or not rated, don't have track record, and don't have analysts following them, and then that's going to be, it's going to be cheaper than equity financing. You're going to want to do that in the form of debt financing, but you will be looking for somebody who understands your company, and that's one of the things we can do.
So, James, since you have different vehicles in your motive partners, structure, so that might be a very good, follow-up from your end in terms of what Eric said. I mean, because fintech seems to be a very early stage investment opportunity at the moment, but in terms of private equity and other, dimensions, how do you look at it?
I actually disagree with the point. I think fintech is a new term maybe in the 6 or 7 years, but fintech is a 50, 60-year-old thing. And if you actually look at something like FIS, which is, to me, one of the biggest fintech firms in the world, and has been around forever, and particularly a number of the companies they've acquired, fintech is age-old, so I don't think it is a new thing. And I think the majority of the value in fintech is actually in the larger scale stuff. I think the really innovative, interesting stuff is happening at the earlier end, but that's anything. So I suppose my view is a little bit contrary to your point, which is actually I think there's a tremendous amount of value in the larger end of fintech. I think it's just misnomered as, these are old, complacent legacy, but actually they were the original founders of fintech. It's just been rebranded in the new era of digitization. The thing is, because financial services has a big regulatory shield that means that it may move slower than some other industries, the fact that digitization has started to take hold and this new term of fintech is new, what we're really talking about in this new wave that we're talking about is really the digitization of the business. And I don't necessarily think that is unique to small fintech companies. I think actually a lot of it is happening within the industry, a lot of it is happening within some of these scale fintech providers. And what we're starting to see, and I think what's really interesting, is starting to see the market properly participate in the fintech ecosystem from an equity standpoint. They've always participated from a traditional vendor relationship, but the way in which now a number of incumbents are participating in the equity of a lot of these fintech companies that support their businesses is really interesting with the advent of corporate VCs, etc.
So in nuts and bolts, so it makes sense to invest in fintechs because it's not a new phenomenon, so it's been going on for a very long time, as you said, right? So
and it is one of the largest technology segments. If you look at the financial services industry, we know it's the largest industry, and the technology that supports that is one of the largest. So, of course, there's a tremendous amount of hype about it. There's also a huge backlog of work to be done. I mean, I think David Burr from 11FS says, we're 1% of the way through the digitization of banking, right? We've got a lot more to do.
I think one thing I would just add to it, Mustafa, is, given all the technological changes that we've seen in all sectors, we also see that in fintech. And there's a massive amount of disruption that is happening at this moment. So while you should always invest in fintech since, going back 50, 100 years, at this particular point in time, there is a lot of moving pieces, which creates a lot of opportunities.
Okay. Wonderful. So, John, you might have a bit of a different look into
I do. I would go back to the original question. I think, why invest in fintech? A couple of things I love about fintech. One of the things I love is you have some very defined pricing models that have been around for hundreds, if not thousands of years. So when you're creating a fintech business, there's so many analogs that you can look to when you're figuring out your pricing and your margins and even your distribution strategy. I mean, I would argue fintech goes back 1,000 years to the invention of paper money. I mean, we're talking about a steady stream of innovations over the course of hundreds of years that have led up till now. So I think that the pace is accelerating. But one of the things I like about investing in fintech is I know that I can rely on existing pricing models as a guide for how I'm going to introduce this product into the market. I know that I can rely on lots of work that's been done on a cost of acquisition basis for finding customers. That's already fairly proven ground as well. But the thing I most like about fintech as more of a generic VC investor is I know there's a buyer at the end of the rainbow. Because fintech technology generally gets sold to someone with a lot of money, i.e. a bank or some form of financial institution. So I know there's a buyer at the end of the rainbow that has a lot of money to buy my business. And that's a very appealing aspect of fintech investing.
So perhaps you can just say also a couple of words in terms of how you work with the investors, accelerators, so on and so forth, because you do not work directly with the fintechs or startups, but with the guys who are investing in them. So how do you compare the fintech, schemes from the non-fintech schemes in terms of your, focus? To you, John. To you.
So we have a slightly different model. We've developed an AI-based solution that filters deals inbound to accelerators that we work with in early stage VCs. And we've built this model based on analysis of around 500,000 deals going back to 1998. It's taken us about 3 years and about $4 million to build the model, and we're pretty comfortable with it. But look, there's a long way to go before this will be actually selecting deals, so we use it mainly for anti-selection. But what we're looking for in the fintech space is pretty much the same thing we're looking for in any space, and that's domain expertise. Like any investor, we want to back someone that's got a proven history in this segment, in this space. We're looking for novel ideas like everyone else, but they need to have some form of reference to something that exists out there. When we're working with the fintech accelerators that we work with, it's pretty much that there's no real difference. We're looking for fantastic founders that have the kind of domain expertise that we can back. But what we do say to our co-investors that are coming into fintech companies is be prepared for a long ride, because one of the things we found in our research is that fintech has a very long J curve. You have to spend a lot of money to, if you're WeChat, you don't get to 1 billion users overnight with your fintech product, with your WeChat Pay. You have to spend years and years and years building that base. Although Revolut and N26 might be bucking that trend.
Wonderful. So can we resonate on the global framework so we can basically pull ourselves back into the region, what is really going in terms of the fintech investments there? So honestly and personally, I'm a bit confused and hazy in terms of how they come up with these numbers. But let's take the CB Insights. So they say it is $40 billion in 2018, the total amount of fintech investments. I have seen different numbers, but let's take this as the baseline. That refers to almost 120% increase comparing to the previous year. But if you just take Ant Financial, I mean, let's put it this way. So if you just take the North America as well as Chinese investments, the rest is something quite it's not a very chunky leftover, honestly. So Yusuf, how do you take up on that?
Yeah, I mean, to address the increase in volume, firstly, absolutely there's been an increase. I don't have the latest numbers, so I'll trust yours. I would imagine a big chunk of that is in payments. So there's been a lot of big deals, and a lot of them. And so if you count those, you'll definitely see very big volumes. And that's for good reason. The payment space is very interesting. We have a number of investments in the payment space as well. We've been invested in Klarna, Remitly, Flywire, and so on. But China, again, going back to John's comment about a billion WeChat users. I mean, I don't know that number either, but certainly it helps to be in China. It's a big country with a lot of users, very much online. And the US, speaks for itself, the biggest economy in the world. I think Europe, though, is having a pretty significant chunk of it. I don't think it's exactly a third compared to those two, but I think it's pretty close. There's been a lot of deals in the UK, in Germany, increasing, in InsurTech especially. There's a lot happening in Germany. I would say London is one of the top fintech capitals of the world globally. Scandinavia, the Nordics, they have a lot in fintech, like iZettle and other companies, and non-fintech things coming out of there too, like Spotify, etc. So I think it's global, and I think you have centers, and hopefully Istanbul will become one of these centers. It could be a regional center. It'll eventually be a global, one of the global centers, and it'll find its own niches where it's good. So I think it's just spreading, and I don't think it will only be dominated by China and US as it has been today. In terms of the big outcomes, I think you will start seeing bigger outcomes in other geographies as well.
So do you think that there's going to be a shift towards other regions in terms of the proportionality of the total amount of investments in fintechs?
I would say other regions will catch up. So if you now look at the biggest, newest companies, you got the Bats in China, and you got the FANGs or whatever you want to call it in the US. I think over time you will have more coming out of Europe. You will have, hopefully, coming out of Turkey as well. So I think it will become more equal, but I think US and China have such a head start in some of these areas that to some extent there will be a bit of a catch-up.
So Eric, the global outlook as well as your prospects.
So I mean, finance has always been truly a very granular, a very you know, made of a very long tail of smaller companies, smaller banks, building societies. Of course, all of us know the very big brands, but in truth, most of the financial services have been done in the past by second tier, third tier, etc. companies, and that was the case in insurance, was also the case in banking, and so on. What you see, of course, in technology, and particularly in the internet, is sort of a winner takes it all. So we have seen Amazon, which is Amazon, eBay, Facebook. You know, you've got the chunk of the internet economy there in just 3 brands, 3 companies, and we have seen this massive benefit of scale in technology. So here you start to question which way will it go? Will it be, you know, diversity over very many different balance sheets that will inherit the world and they will just go fintech, or will it be a few fintech brands that will really kind of roll out? And I think one of the reasons is, of course, that you know, regulations kind of make it difficult to go with a one model globally, run it out, and so forth. So I think that speaks for a more granular sector with many different companies competing for clients' business. But I do think the winner takes it all is quite powerful, So
yeah.
I don't really know which way it will end up.
I would disagree with that just slightly in that I think there's a couple of instructive things. WeChat, for example, went into Indonesia with exactly the same model and pretty much failed. Yes. It did exactly everything it had done in China in a very similar economy in many respects and didn't succeed. And I would note that, again, the winner came into Singapore, Uber, and a little local company called Grab, that of course now everyone's heard of, just used a very different marketing strategy from Uber. Uber went in and did billboards and did leaflets and things, and Grab went and distributed cigarettes to taxi drivers. I just want to point that out as just local knowledge and a local approach, I think, can sometimes beat these global winners. But I also wanted to make a comment on the global outlook here. There's that 85% of the world has credit card penetration of less than 10%, and we see in our research a strong correlation between countries that have less than 20% credit card penetration and take-up of mobile apps. There's this sort of pivot point that's happening here, where if you're China or you're Turkey, or especially if you're Indonesia and India, where the take-up rate is less than 5%, you're going all app. We've seen wealth management platforms in India that are completely just apps. There's not even a web-based platform for this. It's just a smartphone platform. So I think there's this real change happening that's out there. And in younger generations, you're seeing this in Europe, but it's across all age groups, I think, in many of the demographics that are next to where I sit in Singapore.
Yeah. If I may just add to Eric's point, actually, I think it's a really interesting one, and certainly as global investors, one that we've seen as well. So regulation is certainly one element, and it's very hard to find a fintech business that is 100% scalable, that you can take across borders for those reasons. And you find other reasons as well. So regulation is one dimension, interest rates is another. So in one country, you know, a credit card product may be incredibly profitable because of very thick margins, you know, whereas in another country, it may be very competitive and rates may be lower, and it may not be, the same product may not work. So when you look at different rate environments and different regulatory environments, exporting fintech models is a challenge. Now, having said that, there's plenty that can be exported, but we see that's more as an exception, actually, than the rule.
Don't you find also that it's the guys that ignore the regulations that sometimes succeed? I would point to PayPal and Revolut as 2 examples of 2 companies that took a very renegade approach and actually got out in front of the competitors because they kind of thumbed their nose at the regulators a little bit. So I think there's part of that as well. I mean, Peter Thiel said that, what do you say, innovation is creativity in the face of regulation. And I think that's a really, really nice quote when it comes to expanding a fintech service into places that the regulators may not wish you to go.
I think both points are right. I think on the direct-to-customer propositions, the one that are directly in front of the customer, those are the regulated touch points because they're touching the customer. And I think they tend to be market specific, and it is harder to get a winner takes all market when you're going into such a nuanced set of markets. But actually, if you look at the back end of the business, the back end of financial services, where 80% of the cost base is, that's where we're starting to see large horizontal utilities take hold. And that's where large bits of the cost base are coming out, and large global players are starting to really make waves. So I think depending on which part of financial services you're looking at, the front end, I think, may become fragmented, nice thin customer experiences, or Google will own it all, who knows. And then on the back end of the business, actually that's where we're starting to see winner-take-all markets that you were talking about. So I think both arguments are right, depending on what part of the market you look at.
I also see a somewhat different dynamic in Africa and Asia and South America than I see in, let's say, US and Europe, because of course, in the developed markets, people have a very large penetration. Companies have a very large penetration of financial services already, and that is really about, newcomers have to displace existing relationships, existing banking relationships, etc. Whereas what you see today in emerging Asia and in emerging Africa is really a customer base that is now getting wealthier. Yeah. They're not yet at our level, but they're certainly getting wealthier. They are target clients who are really out there for financial services. They do want to, have consumer credit. They want to purchase a house. They want healthcare, and they want to be insured for healthcare and so forth. And they can also pay for it. And what you see there is, of course, that infrastructure that has been developed for over a century in the US or in Europe doesn't exist there. And what you see is a little bit what you see with mobiles. I mean, they never developed, fixed line as much, and they went straight to the mobile. And what you see in those markets is that they directly go into new kind of ways of doing finance, and they're much more open to pick up these new products and these new approaches, because you don't have to push out the old to make space for the new. They step into the new right away.
And from an investment perspective, those are fundamentally different business cases. You're looking at displacing an incumbent. The capital required to do customer acquisition in that scenario is significantly different from accessing a new middle class within an emerging market. And those are things that you have to think about as an investor, because fundamentally, the different things. I mean, we are a global business, but we're very much focused on big infrastructure plays. But you've got to take that into consideration if you're looking at the emerging middle class in India versus displacing a 50-year-old payment firm in the US. Fundamentally different things, and the capital requirements to do so are fundamentally different. And I think this 40 billion figure that you called out will continue to grow. If you look at that, that's a pin drop in the ocean when it comes to the scale of what we're talking about. So if you would have said 100 billion or 200 billion, I still wouldn't be shocked, and I would continue to expect that number to grow, with the caveat there may be some externalities that kind of dampen it, but I would expect that number to increase year over year.
So that externality might be some of the booms and busts, for example, in particular.
I'm not an economist, but
I was referring to some of the segments in the fintech industry. Basically, it might be, for example, the crypto world, blockchain, so on and so forth, because there are lots of things going on.
And if you look underneath, a lot of the growth is being driven by larger ticket sizes. A lot of the companies that we saw 6-7 years ago have grown, and therefore the capital requirements, they're raising Ds and Es and Fs, and those are being factored in, right? And particularly if you look east, look at the makeup of that. Larger ticket sizes are boosting that up, and that's fundamentally the way the market is going. So I think if you actually dig underneath and look at the numbers, it's larger ticket sizes, a growing fintech presence in Asia, and a significant fintech presence in Asia, and that's what's really bolstering those numbers. Yes, banking and payments makes up a significant lion's share, but we're starting to see the emergence of other segments. You mentioned blockchain and crypto, but insurtech is a massively growing space as well, and that's really pumping up the figures as well.
So going back to this winner takes it all, it sounds quite nice when you sing it or when you listen to the song, basically, but in reality, I think it might be a bit bitter for some of the startups, fintech, so on and so forth. And one of the recent moves is basically Uber. Uber is basically a good example, acquiring Careem in the region. So, but the thing is, fintechs or startups, in a way, in a broader concept or a broader context, they are versus banks, insurance companies in a way, against the conventional players. Now they are also big techs. So they are trying to become like financial entities. I mean, there's Apple Card discussion, there's, you know, some of the social media, social networks trying to become, you know, a challenger bank, so on and so forth. So when you say the investments, the total investment is going to, the amount is going to increase, it is something quite nice, and I find it a bit optimistic, but there are also some, you know, downsides with that. Perhaps we should also be talking about what is really happening, what is going to be happening in the future, for example, 10 years from today. Yusuf, why don't you start?
Yeah, I mean, it's hard to predict exactly what will happen in 10 years, but I think, you know, there's a few trends we're seeing, and I think it was Bill Gates that had a quote about being right and wrong about the near term versus the medium term. So, you know, people tend to over and underestimate. I think some of the themes that we're seeing is definitely like unbundling of the value chain, to use that cliche. We do see that, and then we do now see some rebundling under new paradigms. So we do see that as well. I think, you know, the world is getting smaller, but then you have tariffs, trade wars, and so on. So then there's always, you know, cycles, if you will, in the economy. I think, you know, technology as a whole will progress, barring any unforeseen events, and it will not just be information technology. Outside the scope of our discussion today, biotechnology and all sorts of other technologies will actually increase at very fast paces. So I think the challenge is that the change is happening. It's happening at an exponential pace, which makes sense if you look at how science is created. Going back to the regulation point, the real question is how do we as a society deal with that? And then how do we basically create businesses that deal with that in a productive way? And that's why in our last maybe 3-4 years, this has always been the case, but we really increased our focus on financial wellness and doing businesses that promote financial inclusion and equality in society. So I think all those things are very important. So we may not know what exactly is going to happen in 10 years, but we know that there's going to be a lot of change. We know that change creates stress in people, and we know that it's, you know, our responsibility as investors and entrepreneurs to basically build businesses that don't have unintended harmful side effects, which, as we very well know, happens, as you've seen in many examples with big tech recently. Yeah, so that would be my thoughts on that.
So, John?
I guess I would go back to fundamentals. So my business, Hatcher, we're a data-driven venture company. Data is absolutely at the core of our foundation. And if you look at many of the fintech startups, it's the same thing. Data is at the core of their foundation. If you look at a lot of the big banks, they're coming very late into the game when it comes to AI, behavioral analysis. A lot of the big banks, it's estimated some of these guys have between 25% and 40% of customer accounts have wrong data in the database. So I think the challenge going forward in the next 10 years is going to be, it's going to come down to a battle between the people that are able to bring on board data in a very efficient way so that it only takes us 30 seconds to sign up for a bank account instead of 30 days. The banks are going to be the losers here if they don't very, very quickly adapt to the models that are being propagated on the market now. You can sign up for an N26 or a Revolut account in literally a couple of minutes. That's not the case, I think, for all of us when we try and sign up for bank accounts. And if you look inside the N26 and Revolut databases, I think you'll find some very clean, very good understanding of the customer and what they're doing. And this started with Mint 5 or 8 years ago. So I think the banks are going to lose out because they're adding behavioral analysis onto the side of what they do, and they're trying to catch up in a very sort of like small way. But I think the guys that have AI and data at the core are going to win in the next 10 years.
Yeah, I mean, I would echo both of the points. I think keeping the conversation to retail banking, ignoring markets and insurance for a second, I actually think retail banking is increasingly being pushed to the back end of the customer experience. In the future, I'm not sure that there is necessarily an engagement mechanism for individual consumers if required. So I don't think a bank needs to own necessarily the channel. I think a lot of it will sit in the back and you'll be exposed through third-party services. And I think, you know, the advent of open banking is very much the beginning of that. If you look at what financial services really is, it's a facilitator. Why do I need you know, the banking product displayed in the banking channel. I actually want the banking product where it belongs. And I think increasingly financial services is just going to be embedded into everything else. And over the next 10 years, I think that's what we'll see. We'll see, you know, the increasing invisibleness of payments. We'll see products layered into other propositions. We'll see the distribution side really fundamentally change. And I think that will be the big shift in 10 years. And that will be the shift in thinking for the incumbents, which are used to owning the channel, to thinking somebody else is going to own the channel, and how do we ensure that we exist in that channel. I think that big shift of being a single channel owned model to a platform type model is going to be the big shift in the industry, and that's where the big changes will be.
Interesting. Eric?
I think the financial sector, well, we often say, what is stopping companies, broadly, any company, what is stopping any company from innovating? And the answer you will often get is culture, embedded habits, and so forth. I think in finance, we have this problem definitely, but we have an additional one, which is back office. There's so many processes, so many things that banks and insurance companies and so forth do on a daily basis is really kind of limited by their back office, their setup. So the mechanics, the structure is there, and they have no handle on it. Very often they don't even know how it all came together. There's hardly anybody.
They outsourced it.
Yes, and hardly anybody understands the whole picture.
Yeah.
And in particular, as I said, I also work with private equity who acquires companies that have gone slid down the hill and need to be turned around. And they're very often, you know, what is going to limit the pace of the turnaround and stop these companies from directly doing what they should be doing, which is innovating, is their back office. And you really have to understand how their back office works and get them to change that, redo their databases, bring them online, redo their customer acquisition, everything essentially. And you can't just say, oh, here's a cool app, and with that, you're suddenly in the 21st century. It's not how it works. It's a trajectory of 3 to 5 years to take such a company, redo the whole wiring, and you know, and then bring them. And that's what Revolut doesn't have to do, right? They start up with the best technology straight away.
The culture point's really interesting. You know, you used to graduate university and you went into banking or strategy consulting was the ideal outcome. And now it's big tech or some funky cool startup, right? And so you're looking at these incumbents who are trying to fight these people, but the incoming talent pool isn't the same, and the desirability of working for these, you know, incumbent institutions in there. So I think actually the culture and talent point is probably the biggest one.
Culture and business models. My next round would be a bit fast forward for each of you. So I would like you to list perhaps the best three for you, the most favorite ones basically, segments of fintech investments for the next 5 years. Yusuf.
Okay. I mean, we're very specialized, so we have mostly a Capital One background, so we're very much direct-to-consumer focused, even though we do B2B. We focus on credit, especially, and data analytics and product innovation. But I think just to pick a few interesting segments, one is basically being able to attach finance to just about anything. So we alluded to the invisibility of financial products. That's definitely one where we're seeing where if you're running a business, or if you're starting a business, or if you're starting a retailer, or whatever it is you're doing that's non-finance related, you'll be able to add very commoditized, but also at the same time very sophisticated products at a very little cost to enable you to do what you do better. So that's basically attaching finance or fintech to just about anything. I think that's one very big trend. Another very interesting one we're looking at is basically human plus machine. So in many cases, it is about finding those collaborations where AI or software makes people do their job better. So we have one investment in the accounting space. This is a good example where by using technology, the accountants can provide much more services to their SME clients, and they can let the machines do the bookkeeping that they used to do, and they can now actually advise them on loans and doing other things. So that's one example, and we see that over and over again. And then I think the third one, and I'll stop after that, is probably increased verticalization. So in the past, you would have a community bank, your local branch that knew you as a person that would serve you. I think in the future, you'll see a lot more vertical banks. So you'll probably have banks that are focused, it could get as focused as, you know, banks that are focused on doctors and nurses, or banks that are focused on retirees and so on. And that's going to be driven by this ability to attach financial products to just about anything. So that's going to force companies to become much more specialized and understanding the consumer much, much better. And that's going to drive verticalization, most likely.
John?
I think one of the most exciting innovations I've seen recently is what WeChat is doing with its direct-to-small merchant loyalty programs. Loyalty programs are very complicated things. Typically, you have a marketing campaign management system. You have all these different databases you're accessing. You're doing all this work to enable a marketing campaign. What WeChat is doing is flipping it and allowing the merchants to understand who their most loyal customers are on an automated basis. So I can just go and send them a discount directly via their mobile phone and bring them into the store. And I think this is just a fantastic innovation, especially when you think of those billion accounts that they control. That's quite remarkable. So I think there's going to be a lot of innovation in the area of smaller merchants and bringing them online. I'm an investor in Teller, which is a payment company out of Dubai, and we've seen the largest amount of pickup in our customer base from those smaller merchants. When you innovate on behalf of the smaller merchants and you make things easier and more efficient for them, that's a real win, I think, for everybody. The other thing I would say is, again, back to the core concepts of AI and data gathering. A friend of mine in Papua New Guinea developed a KYC app that allows people that are essentially illiterate to sign up for a bank account in less than a minute using a thumbprint and a photograph. I think these, again, bringing the unbanked into the banking community via a smartphone that can do KYC in less than a minute. We're going to see the entire world become banked over the next 10 years on that basis if we can bring it down to that level.
Sure. The three areas I like, I'll copy John on. I really like SME. I think SME is a traditionally underserved place. I think technology is at the point in time where it can serve the diverse needs of the SME base properly, and I think there's a lot of work to be done in that, and I particularly like that. I like supporting the payments infrastructure, so I think there's a large amount still to be done in KYC, AML, in terms of utility data sharing. B2B focused, which you'll notice. And then the last thing, I think there's a lot of people trying at the moment to reinvent core systems. Mm-hmm. And I think looking at some of these people like Leverist, Thought Machine, Sunline, who are reinventing the way the core banking product is being put together, I think that's a really interesting space too.
Interesting.
So I think the Internet of Things will become extremely important in particularly P&C, so property and casualty insurance. The idea that you can, follow non-stop and underwrite on the basis of live data and comprehensive data, say on a property that you insure, or say on a ship that is crossing the ocean and so forth, I think that opens up a lot of opportunity to improve the quality of the underwriting and also intervene ahead of disaster, intervene in things that you see are going wrong. So I think the Internet of Things is particularly attractive for insurance. On the healthcare side, with the institute, we're working on a project with the NHS, where instead of underwriting on a classical basis, we're actually looking at comprehensive lifetime records of 33 million of National Health Service patients. So we know what happened at every stage in their life, and we can see how their health is evolving. That is beyond the sort of data that any private healthcare insurer has used in the past, and I think that's going to be tremendously attractive. I also think that, in particular, that's maybe slightly away from the insurance world. We're seeing an awful lot of innovation in terms of invoice financing, trade financing, and lending to SMEs, where that used to be a business that was completely dominated by the banks and often by the house bank, just one bank that dealt with the SME. That is now open for competition, and I see an awful lot of very interesting experiments which are now beyond the experimental phase, and I'm starting to actually finance new forms of fixed income, new forms of securitizations and so forth in this particular world.
My last round. So I know that there are many startups, entrepreneurs inside the room, as well as professionals who are potential entrepreneurs, because in financial services industry, professionals are basically the key players in terms of starting new businesses, new projects, new ideas, right? And I know that, for example, in Israeli ecosystem, the average age of fintech startups is about 45. So it's basically based on having this, background information. Even though I know, James, you're a bit younger than that. So, but it's changing. But in the meantime, it is sort of a reality in many, countries and markets. So, what would be your advice or a couple of things that you should say to the entrepreneurs?
Well, yeah, I think, age is an interesting one. Yeah, I think it's because of this movie, The Social Network, and Facebook, perhaps, that people have this image of the entrepreneurs, starting it in their dorm room in university. That's definitely a very good path, and a lot of university students should consider starting their own company. But in real life, that's certainly not the only path. You have all sorts of founders, could be any age, practically speaking. And I think the main recommendation I would have is, well, two, I would say. One is focus. So it's really important to be really good at one thing and be really, really focused, as opposed to trying to do a lot of things. That's one. Two, I think, choose your co-founders and your team quite carefully, because from the 10 things that's required to make your startup successful, no one founder will be able to do all 10 of those. And if you can do 3 of those, you're lucky. So you should choose your co-founders and your investors, actually, very, very wisely, because that's going to make all the difference.
There's a University of Minnesota piece of research that shows that entrepreneurs that are 50 years old do 3 times better than entrepreneurs that are half that age. So if you're 50 years old and in the audience and looking to start a business, that's your cue. I would caution entrepreneurs when they're starting a business to raise enough capital to make it successful. If you have a $5 million idea and you only raise $1 million, you will fail. You need to understand the cost of acquisition of each customer, build that into a very sensible chart that we can all understand, and ask for enough money from the investor. The mistake I see entrepreneurs always make is that they assume that coming to us with a $5 million number is better than coming to us with a $10 million number. It's the reverse. We have capital that we need to put to work, so when you come to us with the right number, that helps us deploy capital in a way that is less risky, and it gives you the capital that you need to succeed.
James? I reflect on both of the points, but the one that really resonates with me and the one that I give advice to on the companies that I sit on the advisory board of is relentless focus. Once you are starting to get to close with product market fit, it is very, very easy to start saying yes to people and adding more and doing more. But actually what the real skill is delivering that 9 out of 10 or 10 out of 10 on one specific thing really well, win that space, and then grow from there. So I think that piece of feedback of relentless focus at that early stage is critical. And then I'd also copy yourself again and say, choose your investors very wisely. I think all too often people are willing to take capital from anywhere because they see capital as capital, but capital isn't just capital. You want the dollar that comes with more than a dollar. Anybody can fly to a certain region of the world that's capital rich and probably raise some money from people who they don't really want on their cap table. And at the end, that's going to come to hurt them in later rounds, and other investors won't participate because they don't want to be sitting at the table of that. So I think it's very, very important to choose who you take your money from, and ensure that you're not getting only capital from them, you're getting network for them. Make sure they can open doors for you. How are they going to help you exit? How are they going to introduce you to the people, to investors in the next round, et cetera, et cetera. So I think that becomes a very key point. And you've got to work with these people. Ultimately, the board is your boss. So choose your boss wisely, right?
So I think I'm going to repeat what was said, maybe slightly different words though. Find your customer very early. Find your customers, find your income, find your cash flow income very early. Because you might have a great idea, but if nobody's going to pay for it, then, it's not a great idea actually. It's maybe great technology, but it's not a great business. And then the second one is seek mentoring. If you're not 50 yet, improve your odds by understanding the context of where your ID, where your business is going to be. So seek industry insiders, seek mentors, and that might be, for instance, that in your capital, rely heavily on people who know that industry, who know what you're trying to achieve, and can help you direct the development of your company. Besides just giving the finance, can help you land those initial customers, which you will need very early on, and and those will often be the people who, since they understand your ID better and they see the opportunity better, they're probably the best people who will open their wallet most easily, and will do more than just open their wallet. Maybe they open their client list, maybe they open their industry network for you, and so forth.
Well, thank you very much. And perhaps my highlights would be that winner takes it all, in a way. So no, just joking. But it looks that we need to focus on the functionalities whenever we talk about the new opportunities in the fintech industry. This would be perhaps the first thing, rather than looking into like, I'm doing an AI project, but what kind of an AI project is that? No. You should be focusing on the requirements, right? The needs in the financial services industry. This could be the first thing. Second, so it looks that the investments overall in the fintech landscape are going to continue to increase, right? That is the expectation. Perhaps the share of the non-North America, non-China might also increase in a way. We'll see about that. So James, I'm not going to ask you anything about Brexit in the respect, so that the role of UK and anything else. So it is something still ongoing and uncertain, so we'll see about that. But overall, the fintech investments and fintech overall is going to be a hot topic, even for a while. We can say that, I guess. And it also requires some stamina in order to start a business. For the entrepreneurs, it might be the advice. Second, know your customer, as Eric said, in a way. So get your customer first, and you can basically focus on your business, as well as focus on the functionalities, as I said first. So, well, thank you very much. And our speakers will be outside during the coffee break, during the lunch. And please take time and try to catch them and make a chat and make a chat out of that. So thank you very much. Enjoy the lunch, and we'll continue afterwards. Thank you.